What does it mean to structure a loan? The borrower wanted to purchase a property with two buildings on it, fix them up, and resell them. One had been destroyed in a fire, and the other was down to the studs, which explained why a duplex was going for $1.65 million in Los Angeles. So the collateral wasn't there as is because there are more people, market size wise, who will buy a fixed up house versus a frame of a house. And low demand means lower prices, especially when trying to unload a property in 30 days. As far as credit goes, the borrower had a bankruptcy discharged and credit was below 550. Credibility, another factor in credit, was also questionable because the borrower's only experience was a simple fix and flip and not a heavy rehab or ground up construction where the borrower's name was on the title. The next C, capacity, was just about the only thing the borrower had going for them. As a licensed GC and realtor, the borrower earned quite well and had the cash reserves for a 20% down payment. So how do you structure something like this so that it gets approved? You've probably heard the term loan structuring, but what does that actually mean? In this video, you'll learn exactly what it means, and I'll discuss the three factors direct lenders look at when structuring a loan and two real-world cases that I got approved through some creative structuring in order to get the deal done. With traditional mortgages such as an FHA, VA, or conventional mortgage, borrowers have to bend themselves to fit in the lender's box, which is designed to eliminate their own risk. That means borrowers have to have certain credit scores, debt-to-income ratios, and collateral or equity requirements. They're products that have preset terms, and borrowers have to meet the lender's requirements or get denied. It's like walking into a clothing store and either the clothes fit or they don't. On the plus side, they're mass-produced and cheap. On the negative side, one size doesn't fit all, and only a small subset of borrowers get approved. Loan structuring is the opposite. It's like getting a custom-tailored suit that is unique to your body, your tastes, and your needs. It allows for borrowers with more unique situations to get approved. And like a custom-tailored suit versus an off-the-rack product, it is more expensive. But structuring looks at the borrower and figures out what terms unique to that borrower's capacity and needs while still eliminating the risk for the lender. By the way, I've said it twice now, eliminating risk for the lender. Most people think of lending or investing as risky, but lenders and investors mitigate their risks in order to make sure that in the worst case scenario, they not only break even, but they still end up ahead. Borrowers who recognize this get funded. Borrowers who don't. A good deal is about creating a win-win situation, and loan structuring is the art of eliminating risk for the lender while creating those win-win situations. I'll be discussing different ways to structure financing so that you can win by guaranteeing your lender wins if they finance your deals while eliminating their risk. When borrowers see an offer, they're seeing things like origination fees, interest rates, and down payment and confuse those for the levers. But those are actually the outputs, the results, the terms designed to eliminate risk for the lender. The actual inputs or levers, the actual buttons you push, are the borrower's profile or scenario that decide what the terms will be. For example, a borrower with a lot of cash reserves and a high credit score will get very different terms than a borrower with no cash reserves and a low credit score. On the other hand, a borrower with a middle credit score and 6 months of monthly payments as reserves looking to buy a primary residence will get better terms than a borrower with a great credit score and a lot of reserves looking to buy an investment property. So it's not just about the borrower alone, but the complete situation, the complete picture. And that complete picture can be broken down into three categories: credit, capacity, collateral. These three categories are where risk hides and where we look to eliminate that risk. I like to think of credit as representing more than just credit score. For me, it represents a borrower's credibility. The lower the score, the lower the borrower's credibility, and vice versa. The higher the score, the higher the borrower's credibility. But there are extenuating circumstances and exceptions. If the low score was caused as a result of debt due to divorce, death, or medical expenses, or other valid reasons, it matters. Further, more than just a credit score, a borrower's history of bankruptcy, late payments, and foreclosure actions also matters. It also matters How long has it been since those actions have taken place? If you declared bankruptcy yesterday, you'll be lucky to get any terms. Whereas if you had your bankruptcy discharged 2+ years ago, you'll have more lenders willing to work with you. On the investment side, credibility looks at experience. You could have great credit, a lot of income, or reserves, and have a great deal with numbers that make sense. But if you lack the relevant and specific experience, it'll be harder to secure funding. Capacity focuses on your ability to repay. This isn't about having perfect tax returns, although having perfect tax returns generally secure better terms than most commercial loan products. For proof of income, outside of tax returns, we can look at verification of employment forms filled out by your employer, W-2s, award letters, 1099s, but also bank statements, which all serve as third-party verification. We also look at reserves, be it cash savings, retirement accounts like a 401k or IRA, and even stocks and bonds. For example, let's say you're not working but have 3 million in stocks. Using asset depletion, we can apply various formulas to convert that into theoretical income. In the same category is rental income, either short-term or long-term. As an aside for rentals, we look at the lower of market rates versus leases. Let's say you're getting $9,600 a month gross rents for a building, but market rents are $7,600 a month. You may argue that your ingenuity and business model is what allows you to collect $9,600 a month. And you're right, we'd argue the same, that it's you that allows you to collect above market rates. If you were to suddenly become unable to continue operating your business, then rents would likely fall to the lower of the two. And depending on how you run your business, that can also fall into the next category, stated income. This is income that is harder to verify, which can be a profit and loss statement along with the letter signed by a CPA or tenant leases, either long-term or short-term. The important thing to note here is the big picture, your ability to make the monthly payments, and even then, that's a proxy or measurement for the end goal, which is your ability to repay the complete loan plus interest. This is why for rehab and construction loans, they don't worry too much about your income, but rather the value of the property itself, which leads us to the next lever. Collateral. This covers not only the market value of the property, but the volatility or likelihood the property's value will go down. So when we do an appraisal report, we also look at if property values have been trending down or declining, or if they've been fairly stable in the past 12 months. If doing a broker price opinion without an all-out appraisal, we'll ask what's the most we can get for it if forced to sell in 30 days or less. It also looks at your equity in the property and who else has claim to that property's equity. So if you're looking to pull cash out of your home and you just recently bought it with 0% down, then you have no equity in your home that can be turned into cash unless the value shot up significantly. And even then, most lenders will have you wait 6 months to a year to access that gained equity. If prices shoot up suddenly, they can also shoot down suddenly. So they want to make sure that if they had to foreclose on you, that the value of the property is stable. It's also why LTVs or maximum loan amounts to a home's value are limited to less than 100% of the property's value. This ensures that if the property is sold off for less than it is worth, the lender can still recover their investment. Structuring. Loan structuring is the art of looking at the scenario presented, analyzing it according to the 3 C's of lending just discussed, and seeing where the risk lies and coming up with ways to eliminate that risk. To help you understand some of the ways I structure loans in order to get deals done for my clients, I will share 2 case studies with you. Case study number 1. A client's daughter wanted to pull cash out of her home in order to purchase a new home in order to access better schooling for her children. Capacity. Between her and her husband, they earned over $200,000 a year. Collateral. They had about 70% equity in their home or an LTV of 30%. Credit. Her credit was in the high 700s, unlocking the lowest interest rate available if it wasn't for her husband's credit score, which was in the low 700s. This ruled out a bank HELOC because with qualified mortgages, To prevent situations like what happened in 2008, lenders have to look at the weakest link in the chain. In this case, that meant looking at the credit score of the weakest borrower or that of the husband. But with non-qualified mortgages or non-QM mortgages, lenders can use a higher credit score under one condition. And that one condition is what minimizes their risk. In order to minimize their risk, they don't just use the highest credit score. They only use it if it belongs to the higher earner. Structuring. In order to make this work, we had to show the wife as a higher earner. Between the two of them, they earned $200,000. And while the wife had a higher paying job, the husband earned more money as a result of working one job and having a side hustle that put him just over the edge. In order to make this work, we had to ignore the income from his side hustle. Fortunately, without that income from the side hustle, between the two of them, they still had enough income to fall below the 50% debt to income threshold. And with mortgages, while we have to fully document enough income to prove the ability to repay, we are under no obligation to report every single source of income, assuming the bare minimum demonstrates the ability to repay, especially with our non-QM products. This is why DSCR loans are not concerned with the borrower's income, just the property's gross rents relative to the cost of debt service. As a result, we were able to clearly demonstrate the couple's ability to handle their debts and still pay off the new loan by showing it fell under the 50% debt to income limit, while also portraying the wife as a higher earner, allowing us to use her higher credit score and secure the lowest interest rate possible. Case study number 2. Back to the story from the intro. The borrower wanted to purchase a property with 2 buildings on it, fix them up, and resell them. One had been destroyed in a fire, the other was down to the studs, which explained why a duplex was going for $1.65 million in Los Angeles. So the collateral wasn't there as is because there are more people, market size-wise, demand-wise, who will buy a fixed-up house versus a frame of a house. And low demand means lower prices, especially when trying to unload a property in 30 days. As far as credit goes, the borrower had a bankruptcy discharge and the credit was below 550. Credibility, another factor in credit, was also questionable because the borrower's only experience was a simple fix and flip and not a heavy rehab or a ground-up construction where the borrower's name was on the title. The next C, capacity, was just about the only thing the borrower had going from them. As a licensed GC and realtor, the borrower earned quite well and had the cash reserves for a 20% down payment. Structuring. The main issue was the borrower's credit. Even though total project cost was in the neighborhood of $3 million and the loan amount would have been in the neighborhood of $2.4 million, it had a resale value of $6.5 million. Even if the market changed and they were forced to sell the completed buildings for $4.5 million, there was still more than enough buffer or margin between the cost and the resale value to cover the loan. But given the borrower's lack of credibility or experience where their own money was on the line, who had to see the project through to the completed sale, which includes not only construction but staging it and listing it in order to attract buyers and negotiate the final price in order to still turn a profit, as opposed to just being an employee whose job was done when the construction finished, there weren't many lenders willing to take on that risk. What if the borrower failed to perform? Now they'd be left with a still incomplete project that had the risk of selling for less than they invested. Some lenders sought to eliminate that risk by lowering the LTV or increasing the down payment. That way, a forced 30-day sale would cover the amount lent to the borrower. Further, her actual credit was no good due to the time between the bankruptcy discharge and the present day, as well as their low credit score. As a consequence of lower credit, leverage decreased or the loan amount lowered, meaning what was once a capable borrower, a borrower who had sufficient funds for the down payment, was deemed to no longer have the capacity. To get around these 3 problems, credibility, credit, and capacity, in order to capitalize on the value of the collateral, I suggested bringing on an equity partner. They were already bringing on a partner on the loan with a great credit score, but they needed a partner with credibility, with similar and sufficient ground-up construction experience. And by forming an LLC and using them as guarantors, with them as a minority partner, even though the funds were coming from them, they could eliminate the risk for the lender and get the funding they needed. Now, no individual with the necessary credit and credibility would come on their loan without compensation, but that is one of the trade-offs they had to accept with the focus on the future, that this was the cost they had to pay in order to play. And in the future, after completing 2 to 3 deals using this playbook or structure, they would be able to secure financing for their own projects by themselves without having to give up equity to another partner. Sort of like an internship or apprenticeship, it was the price of gaining the necessary experience. And gaining that experience would also allow them to do the same for future borrowers in their current situation. So the benefits outweighed the costs. Bonus, case study number 3. So this case study is a little different from the previous examples. Unlike the previous examples where the challenge was working borrower defects, quote unquote, this borrower checked all the boxes when it came to being an ideal client. Credit, FICO was in the high 700s. Capacity, the borrower was a software engineer earning $250,000 a year, so no worries about being able to repay the loan. Collateral, the borrower also had sufficient equity in their home. They owed about $800,000 on a $950,000 home, more than enough equity for a simple rate and term refinance without pulling any cash out. Goal, they were looking to lower their interest rate and monthly payments. But lowering interest rates is relative to what interest rate they currently had. If they had a 10% interest rate to start with, 8% is lower than that while still being considered high in today's market. This borrower had a 6.5% interest rate on a conventional loan. At the time, par rates for a conventional loan were 6.25% for a 30-year fixed, and FHA loans were at about 4.99% for a 15-year fixed. The borrower already had mortgage insurance included in their monthly payments, so switching from a conventional to FHA should have been no issue. Structuring. I propose switching to a 15-year fixed. It would have saved them more than $665,000 over the life of the loan. Their payments would have gone up by $1,700 a month, yes, but those excess payments would have been made towards equity, and the borrower was an investor who put all his savings into the S&P 500 and ETFs anyway. Even counting that increase in monthly payments as an expense rather than savings, when compared with actual loan fees, his annual ROI would have been 16.49%. For comparison, the ROI on the S&P 500 averages about 7 to 10% per year, and Warren Buffett averages an annual ROI of 19.9%. This would have been an absolute win for him, but he refused it. And not because of the increase in monthly payments. He just refused to spend $40,000 on loan closing costs, which would have been rolled into the loan anyway, increasing his loan amount from $800,000 to $840,000. Part of that was our origination fee, and the other part of that was third-party closing costs, title, appraisals, etc. But the biggest expense was the upfront mortgage insurance premium, or UFMIP, that the FHA includes on all loans, regardless of how much equity the borrower has in the property. We couldn't control how much third-party costs are, and UFMIP is a flat 1.75% on all loans. But we could control origination fees and interest rate. Origination fees cover our costs, and we still had to get paid. I dropped them to zero. Instead, I offered a slightly higher but still beneficial interest rate, because again, lower interest rates are relative to the current rate. In lending, there is something known as a par rate, or the market rate, for a specific scenario: credit, capacity, and collateral. That means the borrower doesn't have to pay extra to get that interest rate. Think of it like the base model or pizza with no toppings. Some places sell pizza starting with one topping included, but if you want to pay less, you lose a topping. You go to 0 toppings. It works the same way with interest rates. The borrower wants to pay less for a loan, and he could pay less by taking a higher interest rate. By taking a higher interest rate, the loan becomes more valuable because the total monthly interest payments are higher, and thus sell for more on the secondary market, where the buyer of the loan is trying to buy loans that pay them more every month rather than less every month. In this case, I dropped the origination cost to 0 and increased the interest rate from 4.99% to 5.25%, or a difference of about $20 a month. This came with a credit from the investor that fully covered our minimum origination fee. His loan fees dropped from $40,000 to $25,000, meaning his new loan amount would be $825,000, still higher than his original $800,000, but lower than the proposed $840,000. Savings did drop as a result of the higher interest rate from $665,000 to just above $650,000 over the life of the loan, and his monthly payment didn't get much better. Instead of going up by $1,690 a month, it went up by $1,670 a month, or a difference of only $20 a month. But he took the deal. Why? In my first option, the borrower was paying $40,000 to get back $665,000. In the second option, the borrower was paying only $25,000 to get back something similar, $652,000. The ROI on investment was a no-brainer. Spend half and get back nearly the same amount of money. On an annual basis, his ROI went way up from 16.49% a year to 20.06% per year, higher than Warren Buffett's average of 19.9% per year. Small changes in loan structuring can have big effects that mean the difference between a win and a lose for the client. In conclusion, with the right structuring, deals that may have been dead on arrival for other lenders gain new life with some creative and knowledgeable adjustments. Given the need to adapt to each borrower's unique situation can make these deals more expensive at first, but the question isn't whether it is more expensive. Rather, the question is, do the numbers still work? When your current deal structure causes lenders to deny you, you have two options. Wait until you can fit their box in order to benefit from their prices, which can take years for some people, or find a way to profit more quickly by restructuring the deal in order to eliminate the lender's risk and allow everyone to walk away as winners.